Powell, who, oh, I fight inflation. I'm here for the poor. I'm here for the middle class. I'm here for you. What did he do? In 2 weeks, he printed $400 billion to bail out the banking system. You can't have it both ways, Jerome. You can't have it both ways because, I'll say it again, asset bubbles have become so unhinged from reality. Debt levels have become so extreme that if you actually let the natural forces, the gravitational forces of deflation to fix these imbalances, you'd wipe out the banking system. So you're going to wipe out the middle class either way, but Jerome's way is to try to pretend and print money, and the middle class slowly dies, which is what has happened already. Alternatively, he could let some of these things happen that I just mentioned. Home prices fall, you'd have stock prices fall, you'd have what I would believe was a depression for a few years. And then you could start all over again and have a real economy. But who's going to allow a depression? I mean, who is going to sit there in political power and say that's the remedy we need? We need a depression. It would be brutal for a couple of years. But there is, do I like depressions? Am I rooting for a depression because I'm short the market? No, I am not short the market at this point. And no, I don't want a depression to happen because it makes me happy. I actually care about people. And I care about this country. I love this country. I love people. As a Christian. What? But the alternative is to pretend that you could just print money endlessly.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Michael Pento. So Michael's the president and founder of Pento Portfolio Strategy. So Michael, thanks so much for coming on the podcast today.
Nice to see you again, Anthony.
Yeah, I'm looking forward to speaking. Our last conversation was one of our most popular, and I think you resonate with a lot of people. So I'd like to start where I sort of start with most of the interviews. What is your current outlook on what we're seeing in markets at the moment?
Well, I think the Fed is trapped in a kind of a conundrum here because they really need to fight inflation. They know they need to fight inflation. Inflation's way above their 2% target. It's been above their 2% target for over 3 years. It's rising further away from that 2% target. It was 3.2% in the prior month, and then this latest reading showed 3.5% year-over-year growth, which is way above their 2% target, as I said. But it's rising from a rate that's already bankrupt the middle class of the country. They say inflation was up running at around 9% at the peak, came down to 3.5%. All right, big deal. Have a party. Congratulations. But in the interim, 78% of Americans are living paycheck to paycheck. The cost of food is up 37% in the last couple of years. 50% increase in home prices. 50% increase in home prices. So you priced out the home ownership, just when you deal with the price of the home. Forget about when you add in maintenance and taxes and insurance. So, I mean, they're doing a victory lap because they're pretending that, if you take out this and if you take out that and if you take out, owner's equivalent rent, if you take out this thing that went up, then, we reached our 2% target. Well, why don't you take the things out that went down and make inflation even hotter, Anthony? I mean, it's just ridiculous. Inflation is rising at a very rapid rate vis-a-vis their target, and it's rising from a level that has already bankrupted the middle class of the country. So congratulations. We're doing a great job. They know that their 5.25 to 5.5 Fed funds rate is too high a rate when you have an insolvent nation, when you have a $20 trillion of household debt and over $20 trillion in business debt. And 40% of the Russell 2000 doesn't make any money. And credit card debt is at $1.3 trillion. And auto loans are being defaulted at a very rapid rate. And personal bankruptcies are soaring. So they have to pretend that they're successful because 9 is higher than 3.5. But the fact is that they've done a great job of destroying the American middle class. So congratulations.
Like you say there, where they look at they try and take things out, but there's other things that have sort of gone up. I'm sure the same thing you can say with the economy and the GDP, because it seems like numbers keep going up. So I guess why does it look like the economy, at least on paper, is doing well?
Well, it's not the. I mean, I don't know what paper you're looking at, but let's see. The economy was growing at, I think it was 3.5% or so in Q4 of last year. In Q1, it dropped all the way down to 1.6%, seasonally adjusted annualized rate. We just got the April ISM, Institute of Supply Management surveys, and that showed that the service sector of the economy went into contraction after 15 months of expansion. The manufacturing slipped back into contraction too. So according to the Institute of Supply Management, both their surveys, the service sector and the manufacturing sector is in contraction. You look at the National Federation of Independent Businesses, they're warning of really dire things ahead for the consumer. Look at consumer confidence. The economy's not plunging off a cliff right now. I'm not claiming that, but I'm just, you asked me if it's strong. It isn't strong. We're bouncing along the bottom. Most of what you're reading or seeing in reports like retail sales, oh, yeah, how great the retail sales were. That's a nominal number. I mean, when food prices are up 37% in the last couple of years, this the Wall Street Journal calculated that, a basket of food. I mean, has your income jumped by 37% in the last 2 years? Mine hasn't. I don't think hardly anybody's has. So the consumer's falling further and further behind. And you can't have a healthy economy when you have a frozen middle class and a frozen transaction market in housing. Real estate is frozen. Things aren't working that well. I think they're working well for parts of Wall Street right now, AI stocks maybe. But other than that, it's not a disaster yet. Could be heading that way, but it's certainly not anything to write home about. If you look at things like industrial production, it's flat. It's really not a great economy. It's just okay at best.
So if the UK is just, if the US is just okay, then that's probably not a good thing for for the rest of the world then.
But no, I mean, China is just okay, hanging on. I mean, you have GDP is population growth or actually more specific, labor force growth plus productivity. Productivity's rate of change is falling. U.S. has very slight population growth. China has negative labor force growth. Europe is suffering from depopulation. So, like I said, we're bouncing along the bottom. But the problem I see coming is that you finally engendered this inflation because you went down the road of helicopter money, printing trillions of dollars and handing it out to people. And now you have this inflation problem that you have to fight. But if you fight it, what else happened when you took interest rates? Like the 10-year note in the United States went to 0.33%. But 0.33% was a 10-year note. And that caused a lot of people to go out and buy lots of things, borrow lots of money and buy lots of things. So, everybody I know has, multiple houses, at an interest rate that's 2-3%. So that's wonderful while it's happening. But now you say, okay, well, now mortgage is going to cost you 7+%. And the price of the home is, $1,000 a square foot here in Naples, where I live. Well, there's a very limited number of people that can buy that house and afford the insurance and the maintenance and the taxes. I mean, my insurance cost in my house went up 70%, 70, without a claim. The house didn't change in price. 70%. The problem is, like I said, a tremendous amount of debt, unprecedented asset bubbles, and now you have inflation it's becoming intractable. So what does a central banker do?
I guess they do have to keep rates high and drive the economy into the ground to reverse this? Is that what they have to do? Because as you said, if
No,
they just
no,
turn it,
no,
if
no,
they just turn it
no,
the other way, it's just going to go to everything's
no,
going to
no,
go to the roof.
Anthony, that's what they should do. But I mean, is that what they're going to do? Well, Powell, we just had a press conference and a meeting. It was an April press conference and meeting, and what did Powell do? He says, "Well, you know what? Things are going just peachy, right? And we're going to cut the rate of quantitative tightening. We're going to cut it more than half because inflation is, not a problem. If you take this out and that out, if you take all of the things that went up, we're back to 2%. So he's going to pretend. They're pretending now that they've vanquished inflation because they know that the economy is not sustainable at 5.3% Fed funds rate."
Yeah. Have you been surprised by, I guess, how they've been quite dovish, as you said, even though inflation has sort of started to tick up, it looks like it's potentially a second bounce, but they're just, as you said, they're just saying things are okay. We're going to cut soon,
CRB index was up 6% in March, 6% in March. So Anthony, what they really need right now, what the Fed really needs to do, and what consumers really need, is a period of deflation. I mean, that's what they really need. Home prices shouldn't be 5.5 times median family incomes. That's unsustainable. When you have food prices that went up 37%, they need to come down, not up more slowly. That's not a victory. They need to fall. And falling prices is deflation. Disinflation is that they're rising at a slower rate. And that is not something that the American consumer needs. They need lower prices. Now, let's just do a thought experiment. The Fed is in business to keep banks happy. It's the lender of last resort for banks. Banks are loaded with mortgages that are yielding them about 3%, 3 or 3.5%, 4%, right? Mortgage-backed securities right now the prices have plunged because new mortgages are yielding 7%. So nobody wants your old mortgage yielding 3%. So banks are loaded with treasuries that yield 1%, 2%, 3%. But the 10-year note is yielding 4.6%. So they're loaded with treasuries and mortgage-backed securities. So that's mortgage debt, and they have credit card debt and auto loan debt and U.S. government debt. That's all underwater. Now, if what the country really needs is to have home prices drop by 40% and for stock prices to drop by 40% to bring them back into a historical normal relationship, what would that do to the level of bank assets, their price level? They would plunge. Banks would be insolvent, even worse than they were going out of, banks were going out of business left and right in March of 2023 till the Fed came in. Powell, who, I fight inflation. I'm here for the poor. I'm here for the middle class. I'm here for you. What did he do? In 2 weeks, he printed $400 billion to bail out the banking system. You can't have it both ways, Jerome. You can't have it both ways because, I'll say it again, asset bubbles have become so unhinged from reality. Debt levels have become so extreme that if you actually let the natural forces, the gravitational forces of deflation to fix these imbalances, you'd wipe out the banking system. So you're going to wipe out the middle class either way, but Jerome's way is to try to pretend and print money, and the middle class slowly dies, which is what has happened already. Alternatively, he could let some of these things happen that I just mentioned. Home prices fall, you'd have stock prices fall, you'd have what I would believe was a depression for a few years. And then you could start all over again and have a real economy. But who's going to allow a depression? I mean, who is going to sit there in political power and say that's the remedy we need? We need a depression. it would be brutal for a couple of years. But do I like depressions? Am I rooting for a depression because I'm short the market? No, I am not short the market at this point. And no, I don't want a depression to happen because it makes me happy. I actually care about people. And I care about this country. I love this country. I love people as a Christian. What? But the alternative is to pretend that you could just print money endlessly. So that's not the prescription for a panacea, is to hyperinflate your economy. And people say, well, Mr. Pento, well, this is the United States of America, and we will never go down that road. What's the reason? We're not a banana republic, but we're behaving like one, politically, fiscally, monetarily. And people say, well, US dollar is the world's reserve currency. Well, yeah, it is, but it's losing that status rapidly. And I'm thinking about in the Roman Empire, the denarii was the world's reserve currency. That didn't stop inflation from going to 1,000%. So the laws of economics apply to the United States. And if we keep printing, keep borrowing, and continue down this road, that's where we'll end up.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. Yeah, I guess the risk with deflation is if we don't get that so if assets don't decrease and then you get deflation anyway, then people are actually going to be a lot worse off than they will be even with inflation potentially.
Well, it would be nice if we could just pretend that we could just abrogate the laws of economics because we're Americans, but it's just not the case. So when asset bubbles have been inflated to such humongous proportions, they have to deflate. They have to be allowed to deflate. And the answer to that problem isn't to inflate them further. But that's what we're trying to do, and it's just not going to work. It never has, and it never will.
Yeah, that's a good point. So, how are you looking to, I guess, to position yourself? Just currently, and I guess what are you going to look for to potentially change that in the near term?
Well, right now we're positioned for a stasis. So I have a 5-sector inflation, deflation, economic cycle portfolio. Right now we're on sector 3. So it's not the end of the world. Sectors 1 and 2 are when you really have to become defensive. I'm believing that the reverse repo facility will run dry around July, but we'll see. I mean, that the pace of that decline has attenuated significantly in the last couple of months. That's where a lot of this liquidity has come from. But if I'm correct, and that happens this summer, where the reverse repo runs dry and we keep recycling this debt at 5.3% plus, because I don't think the Fed can really cut rates more than once before the election, maybe twice before the end of the year. And you remember under Ben Bernanke, when he finally realized that, hey, we got a housing bubble here and banks are in trouble and we're gonna have to cut rates, he started cutting them in the summer of 2007. He didn't get to zero until the end of 2008. But that didn't stop the carnage. So what's going to happen is going to happen regardless of tapering QT and cutting the Fed funds rate to 5%. It's not enough. So we could be the next condition could be recession, disinflation, and deflation. And there's a totally different investment dynamic surrounding that. From what
definitely. I have. Yep. So when you say you think the repo facility will run dry, is that because of, if inflation remains higher, then bond yields could sort of start to increase, so there's no need for them to sort of withdraw from the reverse repo?
Well, I mean, the banks park their excess reserves in the reverse repo facility because they wanted to get that extra interest. If it becomes clear that the economy is slowing, I believe that the Fed will think about lowering interest rates. And when you reduce interest rates, bond prices go up. So I think banks will say, okay, I want to now buy bonds with these excess reserves to capture that extra yield and principal appreciation before the rates go down. Because the Fed will lower the interest rate they pay in the reverse repo facility. So that money will come out of there, and it'll be very stimulative to the economy for a short term. And then once it's out, it's out. And there's nothing new coming in. So not from a stock basis, but from a flow analysis, that's going to be very negative for growth and liquidity.
Okay, and the risk with there is there's lots of new issuance coming because the US is running a massive deficit, and there's not going to be any, excess liquidity that can come into the market and actually.
Well, here's where you get in problems, Anthony. You start guessing. Well, what if the Fed said bond? What if the OCC and the Office of Thrift Supervision and the Fed they changed the rules where banks can buy unlimited amount of bonds and wouldn't count towards their capital ratios? That could spur a lot of buying in bonds and creation of new money. So you get into trouble thinking, oh, what if the Fed launched another bank term funding program? Why wouldn't they can just do that and bail out the banking system? Or what if Janet Yellen and Powell get together again and launch another round of helicopter money? Those are the things I think they will do, but that's in response to an economy that is crumbling. So how much they do and what they do is why you can't just say, well, I have my money with XYZ broker dealer, and I'm in a target date fund, and I'll be fine because the stock market always goes up. Well, no, the stock market doesn't always go up, and it's gone down for over a decade in this country. It's gone down for decades in other nations, other economies. But what do you own, and do you overweight bonds or do you short bonds? Do you own high volatility stocks or low volatility stocks? Do you own the dollar or do you short the dollar? Are you overweight commodities or are you short commodities? That's what I do. So I can predict the problem, and I could understand what they do to combat it, but a lot depends on what the government's response is, and I will adjust my investments according to what the government does and how much they are willing to interfere. And here's the caveat for you. If the Fed intervenes and the Treasury intervenes like they've done in the past since 1987, with basically some form of fiscal and monetary stimulus, they've always done that in an environment of deflation, of persistent. So the zeitgeist has been deflation or disinflation since 1987. They'll do this next round of fiscal and monetary intervention when the problem is inflation, stagflation, inflation, intractable inflation. So that poses a whole problem for the bond market, because if they come on the other end of this with another round of helicopter money, what happens to long-term rates? Very, very well possibly be that they rise instead of fall. And then there's going to be no healing for the economy whatsoever.
Yeah, it really limits their actions. So, Michael, thanks so much for your time today. Really appreciate it. So my final question is, what is one message you want people to take away from our conversation?
Don't just invest in U.S. stocks in a 60-40 or target date portfolio and forget about it. Think about the massive asset bubbles that occurred in Japan in '89 and China, Shanghai Composite Index in 2007. Japan is still down from where it was in nominal terms after 35 years. Shanghai is still down about 45% since 2007. So it's very beneficial for your retirement to take a more active approach and toggling the level of cash that you have, and how much you have in fixed income, and how much you have in what currencies you own, and what sectors and style factors you own in the stock market, depending on the prevailing macroeconomic condition of inflation and deflation. That's what I do for a living. And that's what I intend, God willing, to continue to do.
Yeah, perfect. Great message. So thanks again. So if anyone wanted to find out more about your work, where would the best places for that be?
So it's pentoport.com, www.pentoport.com. On the website, you'll see a midweek reality check podcast I put out every Wednesday. It gives you my analysis of the salient economic data that you might not hear everywhere else. It gives you, not only the data, but how to think about it, or how I think about it, at least. You can make up your own mind. And if you have $100,000 to it, that podcast, by the way, is $50 a year. If you have $100,000 to invest and you're a U.S. citizen, I will manage your money personally under the IDEX strategy.
Perfect. I'll pull out the description below, but thanks again for your time.
My pleasure, Anthony.
Hey, everyone. Thank you for listening. I really appreciate the support. If you got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right. Thanks again.